Alright, thanks for having me. My name is Robert Peary and I have an exciting presentation today on ratio analysis. So let's go ahead and get started. So what is our goal? Our goal is to analyze 5 companies in 2 industries to determine which industry will be best to invest in. But I have to take it a step further. As co-owner of Harper & Hadley, an online e-tailer, I wanted to take this opportunity to really research the industry my business is in. So I'll also be looking for weaknesses in these industries to give me an idea of where I need to focus my attention. Researching what is working and what is not working will be key to Harper & Hadley's growth. Ratio analysis of 2 industries. The industries I chose were Industry 1, Retail Apparel, and Industry 2, Retail Department and Discount. Industry 1, Retail and Apparel, I chose American Eagle, Buckle, Wet Seal, Guess, and Urban Outfitters. Industry 2, I chose, for the Industry 2 Retail Department and Discount, I chose JCPenney, Kohl's, Dillard's, Macy's, and Belk. This is my website, Harper & Hadley. Feel free to check it out if you like. Website's down there at the bottom. Company analysis compared for Industry 1. We're going to be comparing ROE, EVA, WACC, and price to earnings, PE. Definition time. I want everybody to get on the same page with the definition. So ROE is the ratio of net profits to common equity. EVA is a measure of the dollar value of a firm's return in excess of its opportunity cost. WACC is the weighted average cost of capital and is the weighted average of the after-tax cost of debt and the cost of equity in each year. PE is the ratio of stock's price to its earnings per share. Let's go through the comparisons real quick. We have the row comparison for Industry 1. As you can see, Buckle, the yellow line right here, is very, very consistent. Let's check out its numbers real quick. It went from 31% row in 2009 all up to 50% in 2013. And as you can see, Wet Seal has really fallen off the block here, starting around 2010 in its decline. And we'll look at the numbers for it real quick. Back in 2009, it had a row of 24, and it is down to in 2013 to almost a negative 50%. So let's go ahead on to Industry 1 WACC comparison. As you can see, the weighted average, I missed EVA, I'm sorry. EVA comparison for Industry 1. As you can see again, Buckle is very consistent. And once again, Wet Seal is really getting pretty low there on the value added to their company. The others are kind of all over the place. And as you can see, around 2010, they all kind of constricted a little bit. And we'll get into that a little later on. As you can see, Buckle has been steadily adding to their EVA. At the same time, Wet Seal has been steadily declining. WACC comparison. The weighted average cost of capital, the higher your weighted average cost of capital is, usually the higher the risk. So it makes no, so that's why it's understandable that back in 2008, 2009, all the weighted average cost of capital were fairly high compared to 2010, 2011, and so on. Industry 1, price to earnings. As you can see, Urban is really climbing up there in 2013. Let's take a look at the numbers on it. At a price to earnings of 26. Buckle is very consistent with the other companies. And Wet Seal has actually went to a 0 price to earnings. It has NA, so it's probably negative, but I stopped it at 0. Company analysis compared for Industry 2. Row, EVA, WACC, and price to earnings. The row comparison. As you can see here again, we have one that is really falling off the wagon again, and it is JCPenney. Back in 2011, it looks like they started decline down. And I remember hearing back in 2013, when it's where it's at, on the graph here, that they were having trouble meeting their debt obligations. So I'm sure that has a impact on it. As you can see, Macy's has a very good trend line up. They went from a row. Let's look at the numbers real quick. Macy's, here we go. 7.2 in 2009, and they've slowly climbed up to 2013 to 23.79% row. And JCPenney has actually went backwards. They went from 12.12 in 2009 to negative 26.9 in 2013. The economic value added again for Industry 2 is all over the place, and as you can see, JCPenney has made a little comeback in 2013 with adding value back to its company, but we'll have to research it further to see if that continues. Weighted average cost of capital for the bigger companies, it's kind of looks like they kind of go together. They trend a little, and JCPenney is actually the higher, which I mean the higher weighted average cost of capital. It shows a little bit more risk, so that makes sense. Price to earnings comparison. Now in 2012, JCPenney had this huge blip up to about 49 on the price to earnings. The other companies are fairly consistent, and all of them being around anywhere from 10 to 13 on the price to earnings in 2013. So let's break down row breakdown. Row breakdown is going to be the tax burden times the adjustment factor times the interest burden times the operating margin times the asset turnover times the leverage ratio, and that's going to equal row. So what do they mean? The tax burden is the net profit divided by the pre-tax profit. The adjustment factor is usually around 1. Sometimes it'll get up to 2, and we'll go into that a little bit more. The interest burden is the pre-tax profit divided by EBIT. The operating margin is EBIT divided by sales. The asset turnover is sales divided by fixed assets, and the leverage ratio is assets divided by equity. So let's break into these. This is American Eagle Outfitters, and as you can see, they have a fairly high interest burden, and that's what you want to see. You want to see a higher interest burden than a tax burden. Their operating margins are all positive, which is good, and their leverage ratio, asset turnovers, and adjustment factors are all very consistent, which is a good thing. As you can see here, their tax burden has been hovering anywhere from 47 to about 64. Their operating margins are healthy in anywhere from 8% to 12% in 2013, and their interest burden is right around that 93 to 98 range. Wet Seal, as you can see, we showed that Wet Seal had a very poor return on equity in the beginning, and as you can see, this is most likely the reason why. In 2010, they had this huge tax burden all the way up to almost 390%, and that's really what affected their operating margin, because here in operating margin in 2013, they went negative, and their interest burden and tax burden is, a lot of them are close to the same. So we'll break into the tax burden here, and as you can see in 2009, their tax burden was 95.8. They went up to 2010 to 388, and even in 2013, they're still up to 161. Their interest burden has been around 83 to 88, and then 2013 jumped all the way up to 162. Their operating margin was 6.36 in 2009, and it is now a negative 7.45% in 2013. Alrighty, Urban Outfitters. As you can see, Urban Outfitters was very consistent at the 100% interest burden. They're right over that 60% tax burden, and their operating margins have all been in the positive, which is very good. They've been very consistent on leverage, asset, and their adjustment factor. As we look at the operating margin here, in 2009, they've had a steady little climb. Went down a little bit in 2012, but it looks like they're rising back up in 2013 at 13.39. As we look at Guess here, Guess is a little bit more sporadic on their interest burden. Looks like they went down on their operating margin a little bit here in 2013. Tax burden looks to be very consistent, right above that 60% range. As we can see here, the operating margin has actually been going down since 2010. So might be something to keep an eye on. Buckle. Buckle is by far my favorite again. As you can see, very consistent lines here on right over the 100% on interest burden, right over the 60% on tax burden. Their operating margins have been slowly climbing, and we'll look into the numbers here real quick. Their tax burden is right around the 63 to 62. The interest burden is right over 101. and their operating margins have actually been steadily climbing up to 22.96 in 2013. Let's go ahead and do the breakdown for Industry 2 row. Macy's, as you can see here in 2009, had this huge interest burden negative. That was right after the financial crisis, and they also had a fairly large tax burden in 2009 as well. Looks like they got everything under control after that, which is a good sign, and the operating margins have been steadily climbing since. We'll break down the tax burden real quick. In 2009, they had a 97% tax burden, and looks like they've gotten it under control the last 4 years. They've been around 63 to 64. Operating margin, they've been slowly climbing since that 2009 low, and the interest burden back in 2009 was negative 352%. Right now they're at 78.844 in 2013. Let's look at Kohl's. Kohl's looks a lot like our companies from the first industry. They've been very consistent, even in 2009 on their tax burden. They had a little higher interest burden in 2009. Their operating margins are fairly consistent. So let's look into these numbers real quick. Their tax burden is right around that 62 to 63 range. The interest burden is right around 83 to 92, and they're currently at 82. Operating margin, they have 2009, it was at 9.3. They slowly went up a little bit. It looks like they're back down to 9.8 in 2013. JCPenney, as you can see here, JCPenney is kind of all over the place. Their tax burden has been fairly consistent, but it looks like they're struggling to get a hold of their interest burden. They had in 2012 an interest burden of looks like a negative 50 and an interest burden of 100. Let's look at these numbers real quick. An interest burden of 151 in 2013. As you can see, their operating or their profit margins have been slowly decreasing and actually are at negative here in 2013. And we'll take a look at that. They're negative 7.79%. Tax burden has been hovering around that 62 to 66 range. They're currently at 64%. And let's go to the next one. Dillard's had a huge interest burden in 2009. Once again, they was right after that financial crisis. Their tax burden has been fairly close to their interest burden, which is not good. But at the same time, the operating margins have been steadily climbing, so that's a good thing. Tax burden in 2009, they were at 63. In 2012, they got it to 115.57 on the tax burden, but in 2013, they were able to drop it back down to 69. Their interest burden was 323.84 in 2009, but they've been able to keep it fairly consistent at 77 to 95 in 2012, and they're currently at 89.32 in 2013. Operating margin has been steadily climbing, which is a good sign, from negative 1.6 in 2009 all up to almost 8% in 2013. And this is Belk. As you can see, Belk, same thing. It had a huge negative interest burden in 2009. Their tax burden is fairly consistent with their interest burden. And at the same time, their operating margin is slowly climbing, just like Dillard's. And let's look into this real quick. As you can see, their tax burden has been fairly consistent, which is a good thing. Their interest burden is what they've been struggling to get control of. And it looks like over the last 3 years, they've been fairly consistent. It looks like they've been able to get it under control. In 2009, they had it at negative 233% interest burden. Operating margin has been slowly climbing from 3.4 in 2009 to 8.4 in 2013. And that is the conclusion to my ratio analysis. Thank you for your time. If you have any questions, I'd be happy to answer them. And I'd be happy to go further in depth. If not, have a great day.